Good evening, everyone. I'm Sopia. And tonight I want to talk to you about something that deserves your full attention, because what just happened in the metals market is not business as usual. This wasn't a routine trading session. This was one of those moments where the market pulls back the curtain and shows you stress that's been building quietly for a long time. Gold didn't just rise, it surged in a way we almost never see. In a single day, gold jumped by more than $300, marking its largest one-day dollar gain since the chaos of the 2008 financial crisis. Think about that for a second. Trillions of dollars in value shifted hands in one session. There was no corporate scandal, no surprise earnings report, no emergency press conference. There was simply a repricing of confidence. The oldest form of money on Earth stepped forward and reminded the global system that when uncertainty rises, it still commands respect. Silver didn't sit this move out either. It exploded higher, posting double-digit gains in a single day. Copper followed along. When gold, silver, and copper all move aggressively together, that's not a coincidence, and it's not retail speculation. That's the market signaling something deeper. It's the financial system reassessing what holds value when trust in paper structures starts to wobble. What really concerns me right now, and what I want my Iraqi Dinar news audience to understand clearly, is the growing disconnect between paper prices and the real physical market, especially in silver. Physical silver is becoming extremely hard to find. This isn't fear-mongering, it's a logistical reality. Mints are shutting down operations. Refineries are backed up, supply chains are strained. Many dealers simply don't have metal available, and those who do are adjusting their rules just to manage demand. Minimum purchase requirements are being lowered not because supply is abundant, but because access itself is becoming fragile. This matters because paper markets can move numbers on a screen instantly, but physical metal cannot be created on demand. You can't fake inventory. You can't fabricate refinery capacity overnight. When physical supply tightens like this, while paper prices swing wildly, it tells you the system is under stress. Now let's talk honestly about price action, because I know many of you follow both the fundamentals and the charts. Recently, silver moved into the upper 80s, an area that had strong technical significance. That zone wasn't random. It represented a convergence of key indicators that often act as decision points for price. We reached that area and the market made a decision. Price failed to hold. It was rejected and pushed lower. That rejection is important. It doesn't mean the long-term bull market is over, but it does mean there is real resistance above us and the market is not ready to move higher without resolving underlying pressures. As I'm speaking now, silver in Western markets is trading in the mid-80s. Meanwhile, in Shanghai, prices are closer to 100, with futures slightly above that. That's a massive premium, roughly $15, translating to around 18%. That kind of gap does not exist in a healthy, balanced market. It tells you demand for physical metal in certain regions is overwhelming the paper pricing mechanism. A few days ago, I discussed a scenario involving a critical moving average on the hourly chart. The point was not to predict, but to prepare. If price lost support at that level, a deeper pullback became a real possibility, and that's exactly what unfolded. Price bounced briefly, then rolled over as broader market stress intensified. This wasn't a failure of analysis, it was the market responding to pressure. Here's the key level everyone needs to understand now. That same moving average, which previously supported price, is now above us and sloping downward. It's sitting in the mid-90s. That changes everything. When support flips into resistance, the technical tone turns bearish in the short term. Until price can reclaim that level and hold above it, rallies are vulnerable to rejection. I'm seeing a lot of confident voices online declaring that the bottom is already in. Let me be very clear with you. Nobody consistently calls exact tops or bottoms. Markets don't work that way. What we can do is evaluate probabilities, manage risk, and avoid emotional decisions. One signal that does matter right now is what's happening with open interest in futures markets. In both gold and silver, open interest has collapsed to multi-month lows. That tells us something critical. A massive amount of leveraged positions has been flushed out, weak hands are gone, forced liquidations have already happened. Historically, this type of washout often occurs near important lows. Not always the exact bottom, but close enough that the worst of the forced selling is behind us. At the same time, we can't ignore the broader environment. Risk assets across the board are under pressure. Cryptocurrencies have broken down to levels not seen in months. Equity markets are sliding, with major indices closing lower and investor sentiment deteriorating. Bond yields around the world are spiking. Long-term yields in Europe are at levels not seen in more than a decade. U.S. Treasury yields are pushing toward recent highs. Even Japan is seeing yields near extremes not seen in generations. When bond yields spike globally, it signals systemic stress. Liquidity tightens. In the early stages of that process, everything gets sold. Stocks, crypto, commodities, even precious metals. Investors sell first to raise cash and ask questions later. The safe haven bid usually comes after panic subsides, not during the initial shock. Geopolitical tension only adds fuel to this fire. Headlines about escalating conflict in the Middle East are circulating, and if those situations worsen, markets often react with sudden risk-off moves. Cash becomes king temporarily. Volatility explodes. This is why short-term price action can look completely disconnected from long-term fundamentals. That's the bearish case, and it deserves respect. We have overhead resistance, a failed rally, rising yields, risk assets breaking down, and geopolitical uncertainty that can trigger further liquidation. In that scenario, another push lower would not be surprising. But now let's talk about the bullish side, because ignoring it would be a mistake. Physical silver scarcity is real and growing. Closed mints are real. Backlogged refineries are real. Empty dealer inventories are real. Paper volatility cannot create metal. When physical prices in Asia trade far above Western paper prices, it highlights a structural imbalance. Central banks continue to accumulate gold aggressively. Month after month, year after year, they keep buying regardless of price fluctuations. This isn't speculative behavior. This is long-term positioning. It signals a lack of confidence in fiat systems and a desire to hold assets without counterparty risk. We're also seeing long-term price targets for gold and silver being revised higher by macro-focused analysts at the same time futures markets are washed out and physical supply is tight. Historically, that combination tends to show up near major turning points, even if the road forward remains volatile. It's also important to remember that extreme volatility is normal in precious metals bull markets, especially during periods of currency stress. History shows us that even the strongest bull runs include brutal corrections. These moves shake out leverage and test conviction. They feel awful in real time, but they don't invalidate the broader trend. There's a popular narrative right now claiming that recent price declines mean the long-term thesis is broken. I strongly disagree. The core drivers have not changed. Global debt remains massive. Currency debasement continues. Physical supply constraints persist. Demand from investors and central banks remains strong. None of this depends on short-term political shifts or temporary market narratives. We're also seeing currency dynamics evolve. The dollar has shown signs of weakening against other major currencies, while regions with strong physical demand continue to accumulate hard assets. That supports higher metal prices over time, especially when priced in dollars. So where does that leave us today? Technically, we're in a mixed and emotionally charged zone. The rejection from the high 80s matters. The resistance in the mid-90s matters. At the same time, the open interest washout, physical scarcity, and central bank accumulation argue that we are much closer to a bottom than a top. If price can reclaim higher levels and hold above key resistance, that would signal that the worst is behind us. If it fails and rolls over again, more downside pain may come before the next major rally begins. Both outcomes are possible. What matters most is how you approach this environment. If you are a long-term holder with a multi-year perspective, this volatility is noise. Your real concerns are availability and premiums, not hourly charts. If you are trading short-term or using leverage, every level matters and risk management is not optional. This is not a market where assumptions survive for long. Headlines can reverse sentiment in hours. What looks like a breakout today can become a trap tomorrow. Leverage is especially dangerous in conditions like this. So take a step back. Focus on facts, not hype. Understand both the bullish and bearish cases. Plan instead of guessing. Whether this proves to be the final bottom or just another stage in a volatile process, one thing is certain: these are not normal conditions and they demand discipline, patience, and clear thinking.